Hey viewers, your fast-talking finance friend is back to dish on Buffett, bonds, and why you shouldn't freak over the Fitch downgrade. Get hyped for a wild ride through the wacky world of credit ratings. In today's video, we're going to talk about something that has been making headlines recently: the Fitch downgrade of the U.S. credit rating. Yes, you heard that right. The U.S., the world's largest economy and the issuer of the most widely used currency, has been downgraded by one of the major credit rating agencies. What does this mean for the U.S., its debt, its dollar, and its investors? And more importantly, what does Warren Buffett, the legendary investor and CEO of Berkshire Hathaway, think about this? Well, stick around to find out. But before we get into that, let me give you a quick recap of what happened. On March 31, 2023, Fitch Ratings announced that it had lowered the U.S.'s long-term foreign currency issuer default rating from AAA to A+, with a stable outlook. This means that Fitch thinks that the U.S. has a slightly higher risk of defaulting on its foreign currency debt obligations than before. Fitch also downgraded the U.S.'s long-term local currency issuer default rating from AAA to A+, with a negative outlook. This means that Fitch thinks that the U.S. has a slightly higher risk of defaulting on its local currency debt obligations than before, and that there is a possibility of further downgrade in the future. Why did Fitch do this? Well, according to Fitch, the main reasons for the downgrade were the following: the deterioration of the U.S.'s public finances in recent years, especially due to the COVID-19 pandemic and the stimulus measures taken to support the economy. The high and rising level of government debt relative to GDP, which is projected to reach 130% by 2023, compared to 79% in 2019. The weakening of the U.S.'s governance and institutional strength, as evidenced by the political polarization, social unrest, and erosion of trust in public institutions. The uncertainty about the U.S.'s fiscal policy direction and its ability to address its long-term fiscal challenges, such as entitlement spending and tax reform. Fitch also noted that the U.S. still has some key strengths that support its creditworthiness, such as its unparalleled economic size, diversity, and dynamism, which give it a high degree of resilience and flexibility. Its status as the issuer of the world's reserve currency, which gives it access to abundant and cheap financing and allows it to run persistent current account deficits without facing external pressure. Its deep and liquid capital markets, which attract foreign investors and enhance its financial stability. Its strong and independent monetary policy framework, which has helped maintain low inflation and interest rates and support economic recovery. So, Fitch basically gave the U.S. a mixed report card: some good grades, some bad grades, and some warnings for improvement. But how did the markets react to this news? And more importantly, how did Warren Buffett react? Well, let's start with the markets. As you might expect, the initial reaction was negative. The U.S. stock market fell by about 1% on April 1st, the day after the downgrade announcement. The U.S. dollar also weakened against other major currencies, as investors feared that the downgrade could reduce the demand for U.S. denominated assets. And the U.S. Treasury yields rose slightly, as investors demanded higher returns for holding U.S. government debt. However, these effects were short-lived and mild compared to previous episodes of credit rating downgrades or threats. For example, back in 2011, when Standard & Poor's cut the U.S.'s AAA rating for the first time in history, the stock market plunged by more than 6% in one day, the dollar fell sharply against other currencies, and the U.S. Treasury yields spiked to their highest level in months. The market turmoil lasted for several days and triggered a global sell-off. So, why was the market reaction so different this time? Well, there are a few possible explanations. One is that the Fitch downgrade was not a surprise. The agency had already put the U.S. on negative watch in July 2020 and had warned of a possible downgrade in January 2021. The market had already priced in the downgrade to some extent. Another explanation is that the Fitch downgrade was not as severe as the S&P downgrade. Fitch still gave the U.S. its second highest rating, A+, with a stable outlook for its foreign currency debt. S&P, on the other hand, gave the U.S. A+ rating with a negative outlook, implying a further downgrade in the future. A third explanation is that the Fitch downgrade was not as influential as the S&P downgrade. Fitch is the smallest of the three major credit rating agencies, and its ratings are not as widely followed or used as those of S&P or Moody's. Moreover, some investors may have lost faith in the credit rating agencies after their failures to predict or prevent the 2008 financial crisis and the European debt crisis. A fourth explanation is that the Fitch downgrade was not as relevant as the S&P downgrade. The U.S. government debt market is largely driven by supply and demand factors, rather than credit ratings. The U.S. still has a huge demand for its debt from domestic and foreign investors, especially in times of uncertainty and volatility. The U.S. also has a large supply of debt to finance its fiscal deficits and stimulus programs. The balance between supply and demand determines the interest rates and prices of U.S. Treasuries, rather than the opinions of credit rating agencies. So, what does Warren Buffett think about all this? Well, as you might expect, Buffett is not worried about the Fitch downgrade at all. In fact, he says it does not change Berkshire Hathaway's long-term investing approach. He still believes that U.S. Treasuries are the safest investment in the world, and that the U.S. dollar remains the world's reserve currency. He even bought $10 billion worth of Treasuries last week, despite the downgrade. Why is Buffett so confident in the U.S. economy and its debt? Well, he has several reasons. 1. Buffett's keeping calm and investing on. The Oracle of Omaha has spoken, and he is not shaking in his boots over the U.S. credit score slip. Turns out the Berkshire Hathaway playbook doesn't bend just because some ratings agency gets antsy. Buffett takes the long view. He's still America's one sweetheart when it comes to safe bets. While Washington scrambles and Wall Street shudders, Warren's kicking back, unfazed. For him, it's business as usual. No need to deviate from what's worked for decades just because of some pesky downgrade. Think of Buffett as the captain of a ship steadying the wheel while others run around freaking out. His message is clear. Chill people, I've got this. 2. Berkshire's going hog wild buying downgraded debt. If Buffett's so nonplussed, why's Berkshire still gobbling up treasuries like Pac-Man on a power pellet bender? We're talking to the tune of $10 billion just last week. That's billions with a B. For the Oracle, U.S. debt is still the top dog when it comes to safety. Even with a notch lower rating, treasuries kick butt over stocks and other capital casino bets. Uncle Sam might be looking a little droopy, but he can still pay his tab. While bargain hunters hope for fire sale prices, Buffett knows demand will keep yields low. He's banking on America staying strong even with blemishes. Think of it like buying Apple stock after some bad press. The name brand retains its value. 3. Buffett's playing PR damage control. So why's Warren waving pom-poms for Team America on this? Partly because he hates market panic more than anything. When investors freak out, bad things happen. By staying bullish on treasuries, Buffett's trying to ease fears and prevent cascading catastrophes. He wants to project confidence, like a coach rallying the troops at halftime. His message: chill people, no need to sell off and make things worse. Buffett's optimism is strategic. Stabilizing market moods helps limit fallout. If protecting America's rep requires taking some heat himself, so be it. He can handle a few angry tweets for the greater good. What a guy. 4. The greenback's still good in Buffett's books. While Fitch fires shots at Uncle Sam, Buffett says the dollar remains the world's go-to currency. The heavy-hitter trading partners trust to seal the deal. Sure, America's taken reputational hits lately, but we're still the big kid on the global money playground. Heavyweights like China and Europe need greenbacks even if our grades have slipped. Long-term relationships don't just dissolve over petty drama. Serious players aren't abandoning dollars to some ratings adjustment. Like a top athlete with a minor injury, America just needs to ice its bruises and get back out there. 5. For Buffett, U.S. debt is his security blanket. Remember the financial freefall of 2008? While banks burned and stocks crashed, Warren took comfort clutching his treasuries. When tsunamis strike, U.S. debt is high ground. Flash forward to today. Even with the downgrade, Buffett's staying huddled in that safe space. For him, treasuries remain the ultimate teddy bear, a warm fuzzy thing to cling to when luck turns. Dollar bears say Uncle Sam's blunted his shine, but America's still a bright beacon compared to the gloomy landscape abroad. Buffett's message: hold tight to those treasuries, kids. 6. The downgrade didn't shock serious money. See, the bond market's like Buffett's backyard, familiar turf. He and other whale investors know its tides and dangers. So the Fitch downgrade, while a bummer, didn't upend assumptions. The market's vital signs still look robust to the pros even with criticisms. Think of it like your doctor saying you need to lose weight. You know it's true even if it stings to hear out loud. The diagnosis might be harsh, but it's not a heart attack. For big brains like Buffett, the downgrade was more a stern warning than five-alarm fire. Nothing requiring drastic action, just a nudge to improve. 7. The U.S. still has street cred. Let's keep some perspective. Even after the downgrade, America's still rocking a solid A+ grade from Fitch. We didn't flunk out, just got marked down for crappy behavior. The score slip reflects real issues: governance gridlock, juiced-up debt loads, weak fiscal health. But nobody expected miracles from DC. Fitch's call simply made it official. The diagnosis might bruise our ego, but it didn't strip Uncle Sam of credentials. We're still near the front of the class, even if China's gaining on us with its A+. Hey, competition is healthy, right? 8. Main Street's still anxious despite Buffett's cheerleading. Even if big wheels like Buffett aren't sweating, everyday investors feel uneasy about America's direction. Stocks seem frothy, markets fickle, and of Columbia dysfunctional. Seeing trusted institutions wobble chips away at confidence. Folks feel pinched and overwhelmed, not pumped about buying stocks. So Buffett's assurances, while reassuring, can only calm so much. Joe 401k needs evidence he can trust before jumping back into the roller coaster. People crave security and stability from leaders, but mushrooming risks make optimism hard to sustain. It's gonna take time and tenacity to renew faith. All right, folks, that's a wrap on the Fitch fiasco. The takeaway: Buffett's staying cool and keeping the faith in America. Maybe you should too. What do you think? Do you agree with Buffett? Do you think the Fitch downgrade will have any impact on your investments or finances? Let me know in the comments below. Hit like and subscribe if you want more rapid-fire finance talk with a punchy perspective. Until next time, remember, tune out the noise, trust the oracle, and bet on America's comeback.